Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Dear viewers, in today's video, we are going to cover some aspects of digital platforms. You see, this is a mega trend that has taken over the economy. Be it shopping, socializing, studying, working, healthcare, telemedicine, insurance, food industry, payments, and transactions. There is hardly an area of life that is not disrupted ever since the smartphones and digitization democratized the business. And companies with the biggest potential to ride this trend are the platform companies. Winners don't do different things, they do things differently. These companies indeed are living the maxim. But will they win? India's platform economy is too nascent to pinpoint winners, especially as most of the names just got listed and continue to burn cash and run in losses. But this is not true for all the platform businesses. For instance, matrimony.com is a platform that is a matchmaker for people seeking marriage and is a profitable business. But coming back to loss-making ones, if you look globally, the most valuable companies are internet and platform companies: Apple, Amazon, Alphabet, Facebook, Tencent, and Microsoft. And some of these have had their own loss-making years, and amongst the Indian loss-making platform companies, there could be one that could create history. We are lucky to be analysts and investors at a time when this movement is in its infancy, especially as far as listed space is concerned. While the opportunity is big, so are the risks. On the top of it, it does not help that financial statements are not a real reflection of the value in these companies. So how can one assess the opportunity and the risks in the business model with little help from accounting statements? The video today will share some parameters that VCs look at when they look at the next big winner. With a lot of these overhyped platform companies witnessing correction in the stock prices, it's good to keep track of these aspects. And at this rate of correction, you never know if some of the loss-making businesses could enter buying opportunities soon. Before we move to the metrics, here is a quick primer on what makes a platform business different from conventional. This discussion specifically keeps in mind the digital platforms. Platform businesses are often aggregators, a marketplace, or facilitators that bring suppliers or producers to consumers, thus reducing friction and creating value in the ecosystem. And once the business reaches a particular scale, the platform gets to monetize it. A typical platform business model is characterized by network effects. What this means is that the value of the platform for the existing users increases as more users join it. For instance, what makes WhatsApp so popular is the number of people that connect on it. A platform like Zomato will attract more customers if it has more restaurants listed on it. More active users on Zomato versus a competitor further incentivize more restaurants to list on Zomato, and just like that, a virtuous feedback loop is formed, where growth in the business becomes automatic to some extent. Now, until the business reaches this particular scale where the growth is self-sustainable, it will burn money. The expenses in developing the platform and technology and to acquire the users or suppliers or both are front-ended. And monetization happens at a later stage after the critical mass is reached and network effects kick in. The growth in the later phases of some of the loss-making businesses could be exponential. Reasons: supply and demand feed each other. The fulfillment cost comes at minimal cost as the platform does not have to invest in products and resources to meet this demand. For instance, Zomato doesn't need to own restaurants, Ola doesn't need to own cars, and Oyo doesn't need to own hotels. Once a platform has achieved that critical mass, the growth is exponential with minimal expense from the platform itself. Given the network effect in platform businesses, winner takes it all. At max, there could be two players. The entry or presence of a third player leads to pricing wars and discounts that makes the road to monetization longer, and everybody loses. No wonder that one often sees the weakest players getting acquired by one of the top two platforms. For instance, Zomato acquired Uber Eats. The number of players as such determine whether and when the platform can reach and sustain that critical mass where profits take over the cash flow. Now, with that understanding, it is obvious that you cannot assess a platform's potential just looking at its P&L statement. So here is what you should be focusing on. First, total addressable market, often called TAM. This is the market opportunity that exists for the services that the platform offers. In the best case scenario, a business can have 100% market share as a platform. Its peak revenues in this case will be limited to the total addressable market, and profits and cash flows will follow that level. Before you invest in any platform, you need to identify niches where market opportunity and scalability is huge and the cash burn could be justified. You could compare the valuations with potential runway or make meaningful comparisons with peers using this data. For instance, when you are looking to evaluate a platform like CarDekho or CarTrade and are comparing it to some US-based peer, you should be aware that TAM for used cars in India is $220 billion. In US, the TAM is $800 billion. TAM is like a top-down approach, starting with the total size of the opportunity. What follows next is the assessment of user-based metrics. Now remember the distinguishing feature of a platform, the network effect. More than the profits, the growing base of active users and other user-related data points are critical to track. Remember, the idea is not to get fixated on absolute numbers, but to track the trend over time. Now here are some of the user-based metrics that you should consider tracking. These include monthly active users, growth in the new users, and retention ratio. Retention ratio is a measure of customer loyalty. Another metric used to assess loyalty is churn ratio, which can be calculated as customers at the beginning of the year, less customers at the end of the year, and this number gets divided by customers at the beginning of the year again. A higher retention ratio and a low churn ratio is what you should be seeking. Apart from loyalty, predictability of revenues from a user, growth in revenue per user, and growth in number of users, and customer acquisition costs are some of the critical parameters to look at for specific platforms. So what is customer acquisition cost? Customer acquisition cost or CAC is defined as sales and marketing cost divided by total number of acquired customers. This is where the most of the cash burn happens until a critical mass is achieved. Now burning cash would be worth it if a platform can retain and attract users with high lifetime value. Lifetime value is the money that a platform could generate from a user till the time he stops using it or until the platform loses him to competition. For a business like Zomato, this will be average order value multiplied by number of orders multiplied by retention period. Lifetime value depends on user experience and company's ability to use data science and algorithms to understand customer behavior and optimize it. The next on the list of metrics to track is unit economics. Unit economics could be defined per customer, in which case it is the lifetime value of a customer divided by customer acquisition cost. Or it could be used to define a business model's revenues and cost in relation to an individual unit, which is typically a single item sold. For instance, for Ola, this could be revenue and cost per ride offered. For Zomato, unit economics is defined per order. Now, if you're talking about unit economics, you cannot forget contribution margin, which is revenue per unit less variable cost per unit. Early stage platform companies may show losses at unit economics level or a ratio lower than 1. I would like to reiterate that rather than absolute values, it makes sense to track the trend of all these metrics or compare these with the peers in a similar platform business. Now, another interesting factor to look at is the ratio of fixed versus variable cost. A very high ratio of fixed cost could make break even longer, but once the business scales up, the growth could be exponential and profitable because variable cost per unit would be lower and fixed cost per customers will keep coming down. Higher ratio of fixed cost could also lead to high entry barriers and some early mover advantages. You should also be wary of capital allocation. Most early stage platforms lose money. Some are good losers while others lose it the bad way. Money could be burnt to grow user base versus to service them. Between two platforms, everything else equal, choose the one that spends on acquisition versus the one that ends up spending more on serving existing user. Then, you should also be looking at the distribution of value across users. For platforms with equal revenues, the one with lesser concentration is preferable. For instance, a platform with 1 lakh users, of which 100 account for 80% of the value, is a lot more riskier than another platform with 1 lakh users, where 80,000 users account for 80% of their revenues. Now all these metrics are significantly influenced by a number of competitors in a particular business. The thing with platforms is only those will succeed or survive that can manage to be the biggest or operate in a duopoly. Apart from competition, one needs to be mindful of regulatory risks to a platform as well. A platform that makes money on charging commission on transactions could witness a sharp deterioration in its value if the government puts a cap on commissions. We saw such value destruction in Chinese tech space. Well, with this I have come to the end of the video. I hope it gives you a good head start in analyzing the platform-based business. Just one more thing to keep in mind. Not all platforms are equal. The dynamics of a transaction-based platform such as Ola or Uber will be different from a subscription-based platform such as Netflix or Matrimony, and these both will be very different from an advertising-based platform such as YouTube. While researching for this video, I came across a report from Copenhagen Business School that summarizes this very efficiently, as you can see on the slide. It offers some interesting propositions as well. The transaction-based platforms have the maximum potential to grow from existing users. Subscription-based platforms tend to generate the most predictable and sustainable growth, and advertising-based platforms allow for the most exponential growth in the number of users. Each kind has its positives and negatives, and one needs to assess whether the respective platforms are playing to their maximum strengths. Well, if you found this video useful, please like, comment and share, and subscribe to YouTube channel for more such updates. Thank you for watching. Goodbye.